All right, hello everyone, and welcome back to the PetroNerds podcast. I say this every time, but this is a super special treat for myself and podcast listeners because today I'm joined by a two-time guest, which doesn't happen very often, I guess, because the podcast is pretty new. But I'm joined by Ryan Keys, the CEO of Triple Crown, and listeners will know that Ryan joined us a long time, nearly 40 episodes ago, on episode 39 in February of last year. So Ryan, welcome back to the podcast.
All right. Yeah, appreciate it. And worth mentioning my I'm a co-principal of Triple Crown with my partner Nathan. But thank you. I appreciate
Oh, co-principal. My apology. My sincere
it.
apologies.
No,
Okay.
all good.
Okay.
No worries.
Co-principal. We'll clarify that in the notes. But Ryan joined us today is April. I'm sorry, it's Monday, April 17th, 2023. And we'll timestamp this with oil prices and everything. But you joined me last year, February 2nd, 2022, was episode 39. This is episode 80. And oil prices, were a little bit higher then, but
Mhm.
it's been a pretty wild ride. That was pre-war in Ukraine. um at February 2nd. Yeah. That was pre-war in Ukraine. Oil prices were up, things were amazing, and it was 87.93 then for WTI. More importantly, I think nat gas was 541. That was a pretty big deal. And we
Mhm.
end up averaging, getting at gas prices last year well over $6 an MCF. So that was big. And today we're 80.83. And Brent is 84.70. Henry Hub sitting at 227. So obviously we're half of what we were back then. And Dutch TTF is 1330. We got the 30-year mortgage just sitting under 7% at 0.61. We got the 10-year yield at 3.593. Lots going on on the treasury space, on what the Fed's going to do. That is definitely weighing on oil prices today. But Ryan, I know there's a million things you probably want to talk about. I know that there's a million things I would like to talk about. Um, your private company, you can be a little more candid. You can talk. I don't need intimate details on your assets and operations and proprietary stuff, but I'd love to know. A year in, we talked a lot about your production and inflation. Your production actually looks good, but I'd love to get into a little bit of that, and then we can talk about some bigger, broader stuff and oil prices and OPEC and all that.
Yeah. And yeah, the privates. That's where most of the growth has come from in the Permian, or really all of it.
Absolutely.
Public folks aren't growing very much, and it was a lot easier to do that. 2021, 2022. I mean, like you mentioned, exactly a year ago, pre-Ukraine invasion, oil and gas prices, especially on the gas side, were higher. And everyone knows that Permian companies produce a good amount of gas. Most of our revenue comes from oil. Triple Crown's no exception, but are very sensitive to gas prices. So all in, we're actually right now we're worse on the price front than we were last time I was on the show. And things have gotten more expensive. Um, we talked a little bit about inflation last time, cost inflation. Right this second, we're looking at maybe a little bit of deflation, from say Q4 of last year to where we are now. Maybe it's a little bit softer, but a tiny bit. We're still materially above where we were a year ago, and that squeezed the margins pretty significantly for producers, for E&P companies. Granted, it's coming down from what was perhaps a historic high, or a historic, best year, 2021, 22, in terms of free cash flow. But no, it is harder to grow right now for a variety of reasons. Again, not the least of which is the inflation and the lower prices. That's not to say we're in a bad situation. It's just maybe it was an A plus last year, and maybe we're at a B plus right now. Still pretty good, so can't complain.
Yeah, and I just want to remind listeners sort of where you guys are at. So you guys are in the which we talked about before. You guys are a pretty cool and unique company in that you're sort of in the southern portion of
Mm-hmm.
Midland. And so you're outside, like, when I've had Matt Gallagher and different private companies on the podcast, and something I think I don't want to discount that it is a different year. think you were very honest about that, the inflationary environment even then, and the cost increases you were seeing, and more private companies were, and now we're slowly getting, the public companies have to admit this in their earnings calls. But at the same time, that 20, between 2020 and now, there's still this opportunity, I think, that the public market still doesn't appreciate, of private companies don't have the same, return thresholds. And
Mhm.
with prices being as elevated as they are now, inflation eats into a lot of that. But you're still able to maneuver. So I just think it's interesting. You guys are in the southern portion of the Midland Basin. From my numbers, I'm pulling up on production. You're looking at around 15,000 barrels a day, which you've really shot up. You did about 28 wells last year. Your lateral lengths really increased significantly, over 1,000 foot on average. That's more than double the wells you did in 2021. Well performance didn't outmatch the year prior, but I'm wondering, there's some stuff going on there. But I'd love to. I mean, you seem like you were running a gun and pretty hard last year.
Yeah, part of that, and we shouldn't be quite that high. There might be, I don't know if the numbers were from Embarrass, but on a gross basis, I guess it's about, this includes, what we owe our royalty owners, probably about 30,000 a day right now. But yes, that it is quite a bit higher than we were previously, and part of it was just a strategy of, cooperative commodity prices, last year. So there is a room, typical for private guys. If we're growing, that's viewed as higher risk and probably the domain of private operators. So we do have this kind of natural bifurcation between the publics. Low growth viewed as less risky, whether that's right or wrong, and then
Right.
the privates. Doing all the growth in the Permian Basin. We just had you probably want to bring this up, that Ovented transaction,
Yep.
bought three different in-cap companies last week. Um, Really interesting. They're going to go from 7 rigs combined between those three in-cap companies to 2. So that growth is going to be gone. So
Yep.
where's the growth going to come from in the world? Maybe a little bit from the Permian, but if there's probably not, we probably aren't collectively in a situation where we can meet serious demand growth with commensurate production growth out of the Permian.
And that's interesting. So you hit on a few things that we can get into, and I want to loop back and touch back on your gas production, because that is something I think it wasn't really appreciated. I think last year, about how much gas production we had in the U.S., and what gas was very appealing, and especially appealing for private operators, because gas prices were high, and I think we really see it. We saw it in Eagle Ford. We definitely saw it in the Permian, where operators were able to, not necessarily, I would say, target gas, go directly after gas, but they certainly weren't afraid of it. And there was a lot more comfortability of targeting gassier areas and using that gas drive to pull up. This year is obviously going to be obviously a lot different, because gas prices are lower. You're seeing that materially in how operators are talking about losing money, obviously, on the gas side, or obviously that those prices coming down, but still being close, as long as you have takeaway and you're close to basin. But you're absolutely right on the this acquisition environment, and I think this is really important on. And I know we definitely will talk about the macro and the OPEC cuts and everything, but I
Mm-hmm.
think what captured everybody's minds a couple weeks ago, in addition to the OPEC Plus cuts, was Exxon saying they're interested in buying Pioneer Natural Resources, which is a huge, massive, mega acquisition. Whether or not that will happen is, definitely going to happen, is a big question mark. And then, of course, everyone thinks that's the big wave. It's very interesting to me that we would be having a big wave of, and typically the industry does this, but would be having a big wave of acquisitions as we're going into a recession, as OPEC Plus is cutting, and they're cutting because they know we're going into recession. So there's a lot of different factors here. But the immediate thing in my brain is absolute. That means less drilling, because the public companies are the ones that haven't come back, and the Permian has been this amazing story of the rise of the private operators, which everyone called for dead 5 years ago. Absolutely not dead. I mean, private operators have come back, in a huge force, and still, despite the flip in oil prices, I think September last year was when the rig count flipped in favor of the publics, and there was more rigs, more public rigs drilling the Permian than privates, but still a lot of private operators, a lot of private rigs, and more wells being poked in the ground by private operators than publics in the Permian. And really, that's a story of growth in the U.S. because where you have acreage held by production in the Eagle Ford, in the Bakken, in the Rockies, it's dominated by public operators, and they just have not come back to business. Whereas in the Permian, all you private operators you have, and that has really helped growth come back for production growth, and really helped. I mean, we're at 123 BCF a day of gas production in the U.S. So we had a blip in December. Boy, that ripped back in January. And then same for oil production. Actually, is that we're 12.5 million barrels a day for oil production in January. So there's this growth story, and I think it's really important to talk about with operators because I do view things differently in how I look at the data. But um, you said meeting demand, the inability to sort of meet demand, and really the biggest growth driver we have, is the Permian that has been growing. But to me, it's still very remarkable when you look at the rig count and you match that with production growth, and you look at the activity, and that we have not come back to the activity levels we had pre-COVID, and we're marching our way back slowly and steadily. And it's pretty impressive, that resilient growth story, which obviously you privates really contribute to.
Yeah. Oh, yeah. Exactly. And there still will be some growth. I think that there's just the kind of playing in the gray area between you know certain forecasts. There's the EIA forecast. There's that calls for quite a bit.
Yeah,
And we
EIA is
just had
pretty high.
our governor, Greg Abbott, come out and say, hey, right after OPEC cut a million barrels a day, okay, well, Texas might grow a million barrels a day. That's going to be hard. It's going to be hard for us to do. Uh, maybe over, we're talking, half a decade, 5, 10 years or something, maybe. But yeah, the kind of 2017 through, well, I'll call it 2015 through 20, early 2020 era of 20-30% compound annual production growth out of the Permian. Yeah, maybe we're looking at more like 5 to 7, 10%, something like that. Which, and yes, private operators absolutely will be the majority of that. Yeah, absolutely. You get all these signals from the large caps and the majors saying that they're just going to defend their dividend at all costs, which means basically zero growth. That's what they're telling the market.
You know, and that's interesting. I mean, we've all seen that, right, the last few years. And I'm it's nice if you're a shareholder and you get those dividends. I think the public operators are really torn, and this is where I'm going to bring in the energy transition topic, because I think you can actually see it, and I show it in charts of when you look at the public private split of adding wells back, well additions, vertical, horizontal, all of them, and you see how slow the publics have been bringing wells back, despite very strong and resilient prices, and the price signals from after, through 2020 and up. That ESG pressure, I think, is really significant. And, the public guys, their kind of answer to this is, well, we need to return our money to shareholders, and we need to do all these share buybacks. And so the share buybacks are massive. And, they were very trendy also at previous times. And I think people have to be very cautious about, everybody looks at the market and says this is how it will always be. And that's just ridiculous. It's not always going to be like this. Shareholder pressure is transient. It does shift. And so this pressure to not drill, I think we have to be a little bit careful about, because we should be cautious. I don't know if I've said this publicly, but I'm willing to say it now. Look, if there's a fiduciary responsibility by these public companies, and if you can get sued for climate change, if Exxon can get sued for climate change, we might start thinking about if they're leaning so hard into energy transition and they're using that as an excuse not to drill. We have to be a little careful that they're not, actually, are they completely complying by their fiduciary responsibility of, I would like shareholders to get on the board and say, hey, Exxon, it is 80 something dollar oil. Maybe the best use of your cash is put the drill bit back into the ground and give us some returns.
Mm-hmm.
Because that you're not their share price is not necessarily, and I mean all companies have a small amount of stock of Exxon, but that I just hold, I don't trade. I mean, all these companies, they're not getting rewarded in their share price, and so their answer is to just pay out these dividends, and that's
Mhm.
not a bad idea. But the problem is that that's not the only answer. And if
Mhm.
prices are to come down, we're going to find out really fast and really quick that all the ESG stuff and all the billions of dollars that these companies are throwing, and it is actually billions for many of them, and increasing, that they're throwing to the ESG and the energy transition stuff, it's not paying off. It won't pay off in a share price performance because they are not loved by the general investor, and they're not loved by folks on the green space, and that's really hard. So I think we're sort of caught in these two worlds of the world absolutely demanding this oil and gas and needing the growth, and the public oil companies not taking leadership positions, particularly the CEOs, and not being honest that they're producing for the world, and that they probably do need to grow, and that they're using a bit of a convenient story of, we need to give our money return to shareholders. I'm pretty sure at these prices, at this for 3 years, you've been able to give money to shareholders, and you could have drilled a little bit more. So it's an interesting dynamic we have at play. And as a private, you guys are, I mean, you have so much more flexibility. Obviously, the inflationary environment's harder, and you got to navigate that. But I think the public side
Mhm.
is it's a completely unique ballgame right now.
Yeah, it is. There's a lot of political constraints, and talk about defending that dividend at all costs. There might be a little bit more tolerance for a little bit of growth right now than there was 12 months ago. But anytime someone comes out and says, "Yeah, we're going to grow, we're increasing our capital budget," their stock gets sold off like crazy, and it's reactive. It's
Right.
perhaps
Right.
not I mean, you don't necessarily want to go against that grain, but it takes some conviction. If that could be the best long term answer, maybe short term pain for long term gain. So far, though, that they've certainly not gone against the grain there, and a lot of it is also you know this this big valuation difference between the large caps and the majors and the small caps. And
Yep.
it looks like over the last the era of free cash flow that share prices are most correlated out of all these things to the dividend. Those share buybacks look like it just created noise. It's there are fewer shares outstanding than there were a year ago by some companies by a lot, but those aren't necessarily the reason why their stocks are doing better.
Right.
There's just these big variable dividends, and you look at depending on how you value an E&P, a small cap versus a large cap. There's this massive, gigantic valuation difference, and part of that is it seems like talk about the public folks doing what is politically expedient, perhaps. Some of that is um, maybe from the a trend that emerged about 5 years ago of don't pay if you do a merger, don't pay a premium to the stock
Right.
price, and they've not done that.
Hmm.
As that's happened, the bid on those small and mid caps has just plummeted in comparison. And there's some really good small and mid cap companies out there that call it they're trading at 2.5 to 3 times 2023 EBITDA, and the public counterparts with the same inventory, the same production mix. They're just bigger, and maybe they have a little bit more inventory. They're trading at twice that. And so that the whole idea of zero premium mergers that makes sense when they have about the same
Right.
valuation. When you have this gigantic gap, well, go ahead and pay a premium. It's wildly accretive to do that.
Hmm.
Roll in that inventory if you're afraid of inventory. This inventory from the small and mid cap companies is cheaper than what
Hmm.
you can get in the private M&A market, which is this is really fascinating. What happened last week was, um, you know, Oventive buying these three NCAP companies, good assets, but right next door you have High Peak,
Yep.
Laredo, and SM, each with equally good inventory, trading at much lower valuations than those private companies did that Oventive just paid for them. So it's really fascinating
And
why this is
that could
happening.
do you think, I mean, that's part, I mean, I think you're right that there's definitely a public reaction on these purchases. And I think
Mm-hmm.
that's I have a fair amount of criticism, I think, probably for the people in New York who and the analysts who, looking at this, and when they're trading stocks and they're evaluating this, probably not saying, hey, you should have just bought those companies because they're cheaper. And that's where I think the market, and this is where I think it's so important to understand the energy transition and the investor pressure is unfairly penalizing these mid cap companies. And yeah, absolutely. If you're going out to buy stuff, you should be looking at these companies because then that's why Devon. And again, I'm not trading any of these, but I was happy to load up on Devon and people say, well, you don't buy them as they go down. Absolutely. I mean, that company is pumping out the dividend like crazy,
Mhm.
but they keep getting hammered on a share price performance. And
Mhm.
so I mean, and there's a lot of factors in individual companies and trading behavior and everything, but the dividend is something that's you can always argue, okay, well, we're going to have the dividend, and therefore, people are going to want to have me in their portfolio because I'm paying off a
Mhm.
dividend, and they hold up for a certain long time, and if I'm an Exxon, they want me for the long hold. All those things. The share buybacks get trickier for me, and I've been on the record for this for a long time, way before they were. I mean, people were buying shares back with debt, which was not a smart thing to do. So we shouldn't have been doing this, and lots of people were doing this, and this was bad, so everybody got in the share
Oh,
back by bandwagon, and we all did it. And so we have to be very careful of that. I mean, the amount of share buybacks we're doing, and I'm not with the administration thinking we should penalize companies, but at the same time, come on folks, the trend of the billions and billions and billions, absolutely, at 80 something dollar oil, you should be hedging at these prices and you should be drilling. Because
mhm.
there is one thing, like when everybody's looking left, you should be looking right. And if every
Mhm.
company is doing this, and they're to the point you're making of sort of looking, not seeing the forest through the trees of, or maybe they think they're going to get penalized if they're buying a public company. But it's pretty amazing to think that there's the mismatch we have in the market right now.
Oh, yes. Yeah, absolutely. Yeah, uses of free cash. How much better would those companies have been last year that instead of buying back their shares, and like maybe it's still the right in some way it's the right decision 5 years from now, but right now they'd be a lot better. Would have been a lot better just acquiring a smaller mid cap public company at a massive discount, maybe paying a little bit of a premium, which
Right.
Wall Street's wagging their fingers. No, no, no. They're all afraid to be the first person to do it. They
Right.
almost I can almost guarantee all these big companies have this line of M&A, just this menu they're licking their chops. It's like, well, we can't get them because we'd have to pay a premium, and we're not supposed to do that. So let's go buy back our shares instead. Well, the first person who does that, yeah, maybe their share price is hurt for a month,
Right. But
but
then
six
they
months later they wake up like that was the best use of my cash, buying that
absolutely.
small.
And what kills me too is that we think that it's like the concept and the reasoning they say for buying back shares is the market is not properly evaluating us. Well, you know what? Then you need to start talking differently to the market. And something's got to change because you're telling me that all the share buybacks you're doing, you've done them for 2 years now. The market's still not properly evaluating you. So tell me how the share buybacks are going to change your share price performance. Tell me how the billions of dollars in renewables that have no return are going to change your share price performance. They're not. The share price performance is largely driven by oil prices right now, and by a super lack of love and being penalized in the market. So it means that these companies, and I do include private ones in these, because eventually you guys get your valuations get washed up in this, is that people have to be more vocal about the industry and what the value is of their company, and why it's okay for them to drill for oil and natural gas. They are CEOs of these companies. They put their head on their pillow at night, and ultimately, at the end of the day, their company makes money from drilling for oil and natural gas. And I know Engine Number One made a doozy with Exxon, and it's ruined, their mindset and the whole world around. People just can't wrap their arms around this. But I would like to remind people that the CEO of Engine Number One, who's on multiple boards now, and was just on CNBC the other day, and she said Kanoko instead of Conoco. I mean, and no one corrected her. So it's frustrating to me that exactly, I know, and people laugh when I say
I
that,
didn't
but
I didn't catch that. Sorry.
yeah.
You shouldn't be
So
laughing.
it's a what it no, it's serious. It's like if I wouldn't, if we made a faux pas in the green space that way, but it's clear that
Yeah.
they don't, if you don't even know the name of the companies that you're on. ConocoPhillips is a pretty big damn company. And this is it's so these things are serious, and they're also like, how well do you understand these companies? And by the way, has engine number one's board seat performance actually made a difference in the share price? Doesn't seem like it. So I mean, this is kind of all for naught, and it's really where I think there has to be a come to Jesus moment with these public companies of articulating, we know we're in here for the long haul, and that's hard for them. They can't, with the International Energy Agency and everything going on globally, in terms of the pushback on oil and gas. It's very hard for these oil companies to come out here and say, you're going to need our product for the next 20 years. They know that. And that's where I say I am a little concerned about legal issues down the road if they know this. But they're not articulating it. And I think that's the story to investors, is that most people, as you know, portfolios and everything, people were pivoting back into oil and gas even in 2020 and 2021 when they were seeing inflation. You had people saying this is your hedge. And so they don't push it. Maybe they don't tell their folks, hey, your portfolio is XYZ, you know, um, non-renewables or whatever it is. But people are happy to have it as long as it's giving them a return. And I think that that's where the public guy's got to come out and say, look, we are going to be here for a long time, and there has to be a better articulation, because clearly the market's not moving with with what's going on. It's not moving the share price performance, and it doesn't seem like it's reflecting 80 something dollar oil.
Yeah, yeah, and there does seem to be, yeah, I kind of halfway think that the super majors, especially the Shells and VPs of the world, that a little bit more political pressure, which is than the American super majors, to go diversify, get into renewables, and you halfway think they knew it was going to happen and just needed to be able to show the data. Like you said, I mean, there's all this massive rotation of capital, some of it from oil and gas companies, to go buy renewables assets. Well, if you have a huge rotation of capital trying to buy assets and then the assets on the market don't grow, commensurate with the number of capital chasing them, the price of those things goes up and the returns plummet to the point where maybe they did need to go show their boards and their political detractors it wasn't. And I would like to think that the behind the scenes logic, they actually knew that was happening. I don't know though. I don't know. So yeah, it's interesting to see to see that playing out real time. There does seem a little bit of a quiet rotation back into like, okay, maybe that was too fast. Especially some comments from Chevron's probably been the most vocal there about we're an oil and gas company. We're going to keep doing oil and gas.
Yeah, they've flipped back nicely. I think, I wish that I still don't love the earnings calls, because I think that they spend ever since that engine number one debacle with Shell, Chevron, and Exxon in that same day in May,
Mm-hmm.
they all sort of flipped and lost their minds and have really catered and pandered to that. And I think we've had, you can look at historical case studies of companies who are pandering, that how their stocks have performed. And, the companies that are focused on delivering growth, whatever it is, whether it's coffee, whether it's Coca, pop, doesn't matter. Their share price ends up getting hit. So I think, we have seen Chevron flip back a little bit. And I think getting a lot of, getting letters from the president of the United States, ripping on you for your not giving returns to, your profits that you're making, and not giving those
Right.
profits to the consumer. I think that's had an impact, and obviously such a huge dislocation. So it is nice to hear that. I think there's just, and I'm vocal on that. I think Chris Wright and I talk about it. There's not enough leaders in the business. There's not enough leaders in this space that are willing to be vocal about, I think, as I say, being happy that they put their heads on their pillow at night and realize they produce oil and gas for a living. And we're all fortunate that they produce oil and gas for a living, because we use it. But we just need to be probably more vocal about it. But I think you're right. I think you're absolutely right. Is that they're working through these processes, and some of it. I was talking with an editor of a major newspaper, an energy editor, and he was asking me about how real how real is the stuff that people talk about, the regulatory burdens. And this is
Mm-hmm.
actually something I'd love to discuss with you. Is that, I was walking them through them how they are pretty real. Yes, the administration, the Bureau of Land Management, is approving permits, but at a much slower pace. than they were in previous years. They're not not reapproving permits that are expiring. And so it's a very different environment. And then the signals coming out of the administration, the not refilling the SPR, some serious stuff coming out. And I mean, the EPA rules, the proposed rules on this 700-page document are massive. The SEC rules, proposed rules on climate change, is still out there as well. Those are being talked about now. Those include Scope 3. So I think there really is a burden. And I was reading through the Dallas Fed survey, and a lot of
Mm-hmm.
that mentioned, I mean, the operators that responded to that did mention the the regulatory uncertainty, price volatility, wage pressures, price pressures, people, getting people in the field, all the compounding that really it was sort of bubbling up. And so, I mean, I know that's several things. But as a private operator, you can probably talk a little more. What is the regulatory side? How does it feel? And is it how are you navigating it? And this is where you were in Bloomberg for your stuff with CalPen on methane, so we will definitely
Yeah.
talk about that as well.
Yeah, and I mean, just largely, there's we're on the Texas side of the Permian Basin instead of Midland Basin. No federal land; it's all private, mineral ownership. Have a little bit with university lands, but again, these are all this is all self-contained within Texas, and then our way to the market is via pipeline that is intrastate. Our long haul pipeline transports from the upstream, the wellheads in Texas to refineries and export facilities in Texas. So we're insulated from that, largely speaking. Which unfortunately in Colorado, I mean, since you're transporting hydrocarbons across state lines, you use FERC, there's regulatory approval. There's that extra layer of complication because it does become under the purview of the federal government. So
Right.
it is nice to be insulated, without having to worry about that. You know, Especially with pipelines and things. I can't imagine how much more frustrated I'd be than maybe I am on the daily basis with some other things. If we couldn't get our hydrocarbons to market. It's something as simple as a pipeline, which is maybe it's not the most green thing in the world, but it's a hell of a lot better than a bunch of trucks. A
Right.
lot more emissions efficient, a lot safer, and we still need it. So we do feel fortunate that we are totally contained in Texas, and at least we don't have to worry about that. On the methane piece, and you kind of start all this with the whole ESG thing. I don't even know what those letters stood for 4 or 5 years ago. We there are some things we really care about, and really should be not be political. I think it's hard to or ideological. These are things that first started off by being aggressive recycling water, and this is something that is to just remove all the political discourse around it.
Right.
Everyone benefits if we recycle our
Right.
water, especially if we do it more profitably. Like instead of drilling a well and bringing up a barrel of fossil water, and then using that to complete our well with, and then disposing of that barrel of water, that's expensive. So it's actually this is benefiting our investors. It's benefiting the the mineral owners. It's benefiting the county. It's benefiting us. It makes our jobs easier. There, like everyone wins when we recycle our water. It's regardless of your political affiliation or your ideology.
Right.
So that's it's such a no-brainer. We got really aggressive with flaring, and don't like to really don't like to flare. Just only under very intense one-off situations like avoiding catastrophic safety risk will we flare. We have and before and will shut in our wells for periods of time to avoid flaring, and that's part of being just a good steward of your minerals, and of the resources we're managing, and then making investments to actually midstream investments, to our gathering system, redundant compression. That if you value the put a value on the volumes that are flared, that's the value. we can use to underwrite these little midstream investments. And no, it's not the sexiest investment in the world. It takes years to pay back, but there is a positive return when we think about our flaring over a decade timeline, and it does pay for itself to mitigate and prevent flaring. And finally, what you mentioned on the Cal Penn Bloomberg thing, that was just a natural extension of this philosophy of recycling water, prevent flaring. Let's do this because it's the right thing to do and it's profitable. Let's put enough thought and energy into it to make it profitable. That way, there's just no reason to not do it. It's not even it ceases to be an ideological issue, and it's just like everyone wins, maybe for different reasons, but everyone wins. The environmentalist wins because we're not leaking methane. Our investors win because it's a profitable activity to do. Our mineral owners win because they get higher royalties. And we win because we're employees of a successful business that does these things. So it really just it's an alignment of interests regardless of one's ideology, and that's the main reason we got so aggressive with it. And, no, it's we've gone from there's this old way of measuring things, what is called subpart W, EPA subpart W. It's based on the emissions factors and everything. And we talked about this in the Bloomberg thing, but we took those as correct. This is the edict from the EPA. This is how we measure our emissions through these emissions factors. We assumed they were accurate. They are not accurate. In fact, in some situations, they made things worse, perversely worse. And it's not because they're necessarily bad at their jobs or anything. It's just because the technology did not exist to know
Right.
how much more we were leaking. And we were leaking a lot more than we thought, than the EPA said we were. And then we decided to go capture those leaks, and it's like, oh, look at this! This makes money. Everyone should be doing this. So as it pertains to the new regulation on capturing methane, we don't think it's necessarily we don't think this is a negative. We think this can be a positive. Just isolating this one piece of the whole um, perception of oil and gas. This is one thing I don't think the industry has to worry about very much. The other stuff, where it comes, we get villainized for just being a producer itself, and turn into worst thing that could happen is for Texas to turn into California in this situation where
Or
there's
Colorado.
good resources, great resource,
Right.
great oil and gas assets, and the suppliers are the ones being victimized because there is a just rampant ignorance of how fundamental it is to everyone's existence. And if everyone was aware of their carbon intensity, of their demand, um, maybe that would sway sentiment a little bit. I don't know if that's ever going to happen. How much people don't realize they need oil and gas, at least at the moment, in the forthcoming couple of decades.
Well, that was a really nice capturing of, and I think I believe we touched on this a little bit in the previous podcast a year ago, on some of your methane stuff. And this is a great time for me to clarify, because I did a podcast last week, and I might have sounded like I was a little ixnaying the industries for doing and capturing stuff, and I'm not. I think it's great, and I also think that what you explained there very well is what I would call real ESG. And I think
Yeah.
actually has teeth. You're actually doing something. And I love that you talked about redundant compression, because I think we don't see enough in what most of the market doesn't really appreciate, is that in midstream you need redundancy no matter what. I mean,
Mm-hmm.
pipeline redundancy, especially for gas. I mean, gas, you don't truck this stuff, right? You have to actually compress it. And so the
Mm-hmm.
reason you tend to have flaring is because you don't have that redundant compression, and because you're reliant on midstream guys who put an investment in for pipe that's smaller than when the wells come online and when they come down. And it's this natural way the market works. And it
Mm-hmm.
ends up, especially in North Dakota, we ended up with a lot lot of flaring. Now there's Bitcoin mining and all kinds of stuff going on. But the reality is that there is loss, especially when gas was $10 an MCF, in August of last year. That's a lot of lost money. And I think that
Uh-huh.
redundant compression is really serious. And then you couple that with,
Yeah.
hey, nobody wants us to flare, and this is we can be capturing the value on this. I think that's pretty serious. And so I mean, there's a lot of reasons that to capture that gas. So I think that's great. I also think the recycling of the water, which is not really well understood by a lot of folks. I think that it took a long time for water recycling to even happen because the
Mhm.
regulations didn't support it. I mean, from my understanding is early in the Permian, lots of folks wanted to recycle water, but the
Mhm.
ability to transport water to and from location, there was a lot of restrictions on that. And so
Yes.
the regulatory environment had to adapt to recycling water because you're producing this
Uh-huh.
old salty briny stuff from 10,000 feet in the ground. I mean, this is just as old as the crude oil, and this it's dirty water, and you have to do something with this. Now we produce way more water than we will ever be able to frack with. The demand, it's a fraction. I mean,
Mhm.
we could frack 100% with all the water we produce, and we would still have a
Mhm.
crap ton left over. And
Yep.
so there's probably a lot of movement, what we could actually do from a recycling standpoint of recycling all of that and what you could actually do with it. There's
Mhm.
some I think restrictions on that. It's not as though we're going
Yeah.
to be drinking it
Yeah.
tomorrow. I mean, so
Right. No,
there's some restriction, but no,
exactly.
you have a great point, and I think it was EOG and a lot of others in 2014 that really quit. Part of it was because cost, right? You made the point very well that recycling water. I mean, there's a cost to dispose of this water, and if you can do it cheaper
Mhm.
and recycle it, these benefit. And so I think you've talked, between methane and flaring and water. You know, we thinking about the cost side, I think is hugely important. I do have a
Yeah.
question on the methane side because it is if you look up Triple Crown, you will see this thing with Calpen, and it's a picture with him and Ryan Keyes, which they say left. There's a picture. I'll just show you guys this. And I found it on my Bloomberg thing, which was funny, but it says co-founder of fossil fuel company Triple Crown Resources to find out how his West Texas company eliminated most of its methane leaks. And I've met with some folks here in Colorado because everybody's talking about methane reductions and measuring
Mhm.
and being able to have those measurements, and so we can export all this natural gas to Europe. And I'm not against the actual measuring and against solving these problems. I'm concerned about that Europe is requiring us to have these measurements when they weren't requiring Russia to have those measurements per se. And
Mhm.
so people who are doing it better always get penalized. And Canadian oil
Yeah.
sands, when they were transparent about their GHG emissions, they get penalized. And so the countries in which we
Mhm.
can produce this the best way possible with the standards, we're penalized for it. And so it isn't that you shouldn't be doing it right. It's just that there's also implications of are the regulations
Mhm.
intended to make you better and to help you thrive as Triple Crown, or are they intended to eventually put you out of business? And I'm pretty
Yeah.
concerned that there's an eventuality of it is there's a lot of folks when it's politically driven, which much of it is to put you out of business. And it's
Mhm.
like, we'll take your gas now. We're not going to sign a long-term contract for it. So it's really hard to say, well, we want all these regulations pushed on the methane. We need you to hit all these metrics, but we're also not going to sign long-term contracts. So then we don't have
Mhm.
investment on the LNG side. Things get really messy here, and there's a whole
Mhm.
ecosystem in oil and gas with the investment piece. So I think this methane
Yeah.
bit is it's not that I'm against any of it. It's just that the difficulties of I know that
Right.
for a lot of new production, it's pretty easy, right? For my understanding
Mhm.
is to once you know what you're doing, it's pretty easy to solve these. It's pretty cost efficient. I'm told that the older production is the stuff that is more expensive. The stripper stuff is more expensive to deal with the methane leaks. Is that correct?
Yes, exactly. Older facilities that were built before Quado A, certainly before Quado B, when this stuff became best practices. Like if you have an old field with 50 vertical wells that were all drilled in the 90s, and it's going to an old an old tank battery. It's not probably not going to have a vapor recovery unit. It's going to have gas pneumatic. It's going to be all these things. But yeah, that retrofit is that is the most marginal. That preventing those leaks. The way the whether this was intended or not, I don't think it was intended, but the way it was structured from the EPA, the next generation methane rule, those very low rate wells are going to be, uh, depending on how you want to monitor them, they're all going to be almost de facto exempted.
Okay.
We're talking about detection thresholds and being able to quantify the leak. And there's probably end up going to be a choice where you have a type of where you can choose a technology to detect your leaks that has a detection threshold. It can't detect lower than a certain volume. If your well or your battery is below that volume, it's de facto exempted. It doesn't say that anywhere, but it's going to be exempted. So, and those are the types of things. If you look at, if the concern really is keeping methane out of the atmosphere, carbon dioxide equivalent, if that really is the concern, our dollars as a society should putting be put towards those which have the largest impact of either preventing CO2 equivalent from reaching the atmosphere or removing it. And spending a lot of money on those tiny little leaks is, dollars per CO2 ton of CO2 abated. It's very, very poor. So I don't think that's necessarily inconsistent with the stated goals. But it's really interesting that the nuance. We spent a lot of time trying to figure out those the new methane rule and yeah, at least that by itself, taken in isolation. Yeah, I hear you on perhaps the slippery slope
Right.
into a broader theme, but taken in isolation, I don't think it's something that the industry needs to be
Right, and
worried about.
I think it's also statewide. I mean, here
Yes.
in Colorado, there's a tendency to just plug the well, and I also
Yeah.
think we do have to think of a wider. When we started this podcast off, we were talking offline briefly about the macro, which we'll come to, but we started talking about the ability to grow production, and I'm pretty,
Yeah.
in this world where we have so much geopolitical volatility and uncertainty. I am not going to. I've never been a fan of plugging wells, I
No.
mean, because I think we have a tendency to plug wells. We raise our arms and say this is not economic, and
No.
how well has the economics actually been studied? But I mean,
Mhm.
when you plug a ton of wells, and we think cumulatively what smaller production adds up to, and we also think about what the ability to enhance production from older wells. I just think that we have to sort of put a pause button on there. So I think your point is
No.
very valid. Of certain states, I think, are imposing, and
Yes.
pushing operators to sort of plug these and be done with it. And that
Yep.
is a tendency to push. Going against the oil and gas, right? And just in
Yep.
general, it's that we'll just get rid of this, and it's our starting point to get rid of it. There's a lot of money coming from the administration in different forms, and has
Mhm.
with COVID, to P&A wells, and folks took it.
Mhm.
I just think that whether you took money for P&A during COVID and then you plugged your wells like they did in North Dakota, I'm pretty sure
Yeah.
a couple of us could probably find that a couple of wells of those were economic, and that maybe
Oh,
at $83
sure.
oil we could have made money. So I just
Yeah.
think those are, yeah,
Yeah, you're right. With different state regulators, yeah, very different way of looking at these issues, and yeah, our reference point, because the federal rule is so much more strict than anything the Railroad Commission
right,
requires, that we're following the federal rule, whereas folks in Colorado, um, they really have to look at what the state rule is,
right,
and where that's more strict. And often, especially on the methane side, it is going to be more strict.
right.
And like being in Texas, we just don't have that. We don't have to look at those two standards as having to follow both of them. So no, that's it's a good point bringing up different jurisdictions. This is very different environment depending on the jurisdiction.
And I mean, I think, and you guys are really forward thinking on this, because I do hear folks that are on, multiple, I would say, nonprofits and various organizations that are really pushing to on a myriad of levels, on pushing for
Mhm.
CO2 emissions reductions and methane. And I've heard comments from them, and I won't say the names because it was under Chatham House rules when we had a discussion, but they were mentioning how it was hard to get operators in the Permian, especially the privates, to take this stuff seriously. And obviously you
Yeah.
guys are different to that. But it did make me think of, I was trying to articulate to this gentleman that, hey, they're it's not that these people are just, want to rip through these emissions and are just don't care about anything. But they have a lot of other things on their plate as well. And we were talking about, labor and inflation, and it's sort of like, you're hitting a point, especially during the course of last year, that nobody's going to want to flare gas at the prices that we had. No one's going to want to, actively get rid of this stuff. But there are a lot of other things that pull a person's day to day. I mean, when you're running a business, especially if you're private, there's a lot of other factors going on, and depending on who your PE backer is, and I mean, there's just a million different things you're thinking about, and especially as inflation, just getting people into the field, dealing with the inflationary environment, getting your stuff on your location. I'm not sure that all these things level up, to, oh, we have to be dealing with this. And so
Mhm.
there's a difference, especially when this play has so many private operators, and these are small,
Mhm.
individual, unique companies that have a lot of different factors that they have to deal with. It's just not something that
Mhm.
everyone's, this is our number one priority, and we have to do this at
Yeah,
all costs. So it gets a little bit tricky, and I
sure.
was trying to answer back to these entities that were trying to wrangle these guys and saying it was
Yeah,
difficult to wrangle them to get on the same page. And I thought, well, that's because they're dealing with, a lot of other factors,
sure.
and it's complicated business.
It is, yes, and that was one of the reasons for being kind of trying to be vocal about it is the immediate reaction, which is understandable. What we were talking about methane regulations, greenhouse gas scopes 1 through 3, is to just look at this like, oh gosh, like a lot of the world does not view us in a favorable light, and looking at this as like being punished or being yeah, it was basically just being punished. It's a stick. The motivation is to prevent from getting punished and from getting shamed. And that's not a very comfortable place to do anything to start a project. Is, well, I'm only doing this so I don't get punished.
Right.
We're all adults, but we all have we're kind of all just barely evolved children in some respects. So I don't think humans ever grow out of that. No one wants to be
No.
shamed into doing something.
Right.
So that's why we got pretty aggressive about just telling the story. It's just like, hey, it makes money. Like,
Yeah.
don't worry about the stick. Like, go
Right.
chase the carrot. Like,
Right.
there's a reward out there, monetary reward. Let's make this interesting. Let's make this like, hey, here's a bunch of profitable projects we can go do. And looking at it that way, and by doing that, you just sort of you take care of all the punishment stuff because you're you're not you're over complying because it's profitable, and you don't have to worry about the regulations because, well, I would do this anyway even without the regulations. So it's yeah, it is hard, and even those in other states like like in Colorado probably still doing this because of the stick treatment. They don't want to be punished. They don't want to.
Right.
So you know there will be more, and hopefully there will be more stories like this where you got good quantification, good measurement, and create a good, uh, just numbers. It's just a project. It's a profitable project, and we'll end up with another white paper out there so people can look at our numbers and how we derive them, and it's fairly black and white. That it is, at least for us, it's profitable.
Yeah. No, that makes it makes great sense, and I appreciate the feedback. And so there's two things I would like to wrap up on, or bring this full round, because I still want to talk to you a little bit about what that inflationary environment looks like. If we're seeing that come down a little bit. I talked to a lot of different companies, work with a lot of different and service companies and operators, and staring at the rig count chart, and just by staring at that, I can tell I'm guessing on day rates, the rigs might have come down a smidgen, but on the frac side, and actually reading through all the Fed comments, the Dallas Fed comments is funny, because the comments between the service providers and the operators is the same story it's always been, which is the service providers have too high prices, and the operators are saying, well, service providers haven't recognized, the service guys are saying operators don't recognize we got to keep our prices high, and then the operators are saying the service guys don't recognize the market's declining, we need lower prices. And the service guys are like, yeah, we can't lower prices, we just got them to where we needed them to be. And so you got all
Yeah.
these externalities. And so
Mm-hmm.
I want to, I maybe we'll just go there, because I want to loop back to some EPA stuff in the G7. But curious on this inflationary side. I know last year was a really daunting year for a lot of folks. It took about halfway into the year for me to hear consistently from operators and from people in the field that multiple times people just were not getting people quitting in the middle of a job, or and not being able to get a frac fleet, or not getting in a truck for not a frac fleet, sorry, not be able to get a trucker for sand or something, whatever it was, and it would cause them a delay of actually completing these wells. And then I was hearing that people, it was the actual the level and quality of people that just weren't trained up enough. And we've had so much efficiency in drilling and I mean, especially in drilling from 2020 2021, that I think in 2022 I was finally starting to hear mid-year people saying, crap, are the people we have, some of these new people are just not up to speed, and so we've actually slowed down our operations a little. And it wasn't massive, but it was enough that I had heard it anecdotally a few times. So I'm just curious, from the inflationary side, labor side, what are the big, like, what are you actually seeing and feeling, and how is it working through the system now?
Yeah, and it did. It has slowed down the inflation. If anything, we have some very fairly detectable deflation going on a
Right.
few items. So, one of our wells, might be about 5% less expensive than it was last quarter. 90, 120 days ago. Something like that. And so that's it's good to see that it's not it's a worst case scenario, it's plateaued. And that does have a lot to do with commodity prices not
Right.
being as nice, especially on the gas side.
Yep.
And there will be hopefully this volatility isn't good for anyone, and you know us included. The folks in the Haynesville, Permian's just massive, supply growth for natural gas, and
Right.
then Haynesville grew like crazy. And God, I'm glad we're not just a dry gas operator right now. That would not be fun. But yeah, we are seeing, if anything, a tiny bit of deflation. We don't think we're atypical. Obviously, the industry needs service companies to be able to make money. We need them to be healthy. We rely on them, to they're a vital part of the supply chain, equally as vital as the E&P or the pipeline company. So we need them to be healthy financially. But there is, without getting, who should be cutting costs where, is like there is margin compression big time. Our
Yep.
revenue is down, our costs are up, our free cash flow is what we just that's our return.
Right.
Especially if you're not growing back to your shareholders. If you don't have any margin, you have less incentive to grow.
Right.
It's a very painful math problem when you get to that point, you don't have any margin left. But yeah, you just cancel capex and defer capex, and hopefully that the pain is minimized on everyone's side. So without the volatility. So yeah, it's definitely there this year. It's still good. Grand scheme of things at the moment in the Permian, but you might go from good to pretty good if gas prices improve a little bit.
Yeah, and I mean, I think that's really where it's something I always talk to folks about. When people are asking questions about the health of the business, and I always say that it's always stability and predictability, sort of, for any
Yeah,
business, and that's why regulatory stuff is so important. But it's also
yeah.
price, and I think there's something everybody, the this administration has painted the industry as so evil of wanting these high prices, and there's not a single operator or service provider I can even talk to that was really actually excited when OPEC Plus cut and, oh, prices are spiking up, because most folks they don't want this volatility. Would be in a lot healthier spot if we were at, say, consistent $70 to $75 oil. Yes, it's a little bit less profitability, but everything comes down. And I think that, and we need higher gas prices, because last year, having a spike at $10 an MCF, I mean, we did have wildcatters. I mean, we had everyone stepping out, going crazy on the gas side. We have 123 BCF a day in natural gas production, and we had a very warm winter, and gas prices came down. And I think it's funny, it's not funny, but I mean, if you actually just chart rigs and prices, you need to be charting oil rigs and gas prices, because actually the shift in the handful of those, it's a decent handful, is a chunk of rigs that actually
Mhm.
change because their exposure to nat gas, and that has helped, I think, a little bit in terms of the crazy inflationary, we just don't have enough rig everything, so it slows things down. But yeah, it's really hard in dry gas, and it's so easy to produce, and we have so much of it. It just matters. So I think that these price stability in price, I think, is super key for everyone. And that
Mhm.
gets us into these two critical things. And I know we're running up on time. So we can debate whether we should split this in two. But so two things, and this is why I want to close of that. It's why I think the regulatory piece matters so much, is because we do have a disconnect between sort of what happens in the field on a day to day and the great stuff you guys are doing and how well things are running and everything versus what's sort of going on top down from what's coming out of the White House and the EPA and the administration, and obviously what's going on with the G7. OPEC Plus did their cut. We spiked to $83. Now we're at 80. There's lots of pressure from Fed moves and inflation, and that's sort of moving oil prices around. But we're $80. Clearly, OPEC Plus cut, thinking they wanted to hit offshore covering. We're heading into recession. Lots of issues going on there. But the EPA came out with this massive 700-page document last week on it's the Biden Harris quote. Biden Harris administration proposes strongest ever pollution standards for cars and trucks to accelerate transition to a clean transportation future. And it's something that I know it's a little harder for a lot of folks in the E&P space to necessarily focus on the downstream, but this is a major piece of legislation that if this gets implemented, refiners will go out of business in the US, but so will upstream producers, because it's going to be very messy if those refiners go out of business when you can't directly send this to market. And so this is just a basically massive agenda to accelerate electric vehicles, shove them into the grid as fast as possible, shove them in and accelerate the adoption or force the adoption, sorry, and then take these internal combustion engine vehicles off the road. And this does get into the sort of end user scope 3 emissions and everything, which I know most oil companies have definitely pushed back on. But it's really serious. It's 700 pages. It's ridiculous. It's probably not legal. It's going to get a lot of pushback and everything. So it hasn't hit everyone's radar, probably as
Hmm.
much as it should. But it's something that I throw out there of thinking that it's not something at a private operator or even a public you think about. This isn't a tomorrow thing, but it's near to reality, and it's where I think that if folks are bold enough as you guys are to be talking vocally about flaring and methane, it's also being able to capture these types of regulations and explaining why they're
Mhm.
good or why they're bad, and why they don't make
Right.
sense in this world. And to that end, and before I let you want to comment on this, so we mentioned this before, but I have to say this because this is insane. This is the G7 communique. This came out yesterday. So this is G7 is in Japan. They are I don't know how much anyone you or other folks have followed this, but there's been quite a bit of pushback from Japan on G7 communications with regards directly to energy. So they've been wanting to talk about LNG. There's a lot of folks that if you talk to folks in DC, the White House specifically has pushed back on Japan wanting liquefied natural gas, saying they want G7 communication. This has been going on for a year, that they want it to say they want investments in oil and natural gas. The White House, the Biden administration, largest producer of oil and gas in the entire world, does not want it to say we need investments in oil and gas, which is amazing. It's pretty anti-American in a lot of ways, pretty anti-American energy security, pretty anti-energy security globally. But anyway, so the document comes out. I'll send this to you. But it's G7 Energy Environment Ministers Communique. It's long. I almost made it all the way through it, and it's almost at the back end. So there's lots of stuff about energy transition, lots of inclusion in the energy transition, women. Um, okay. All right. My apologies, folks. That was my German Shepherd barking. I'm pretty sure I was getting alcohol delivered that didn't get delivered because um, Axel was barking at the person, and apparently Ryan's German Shepherd woke up to this noises of Axel as well. Um, but what I was saying was this. So this G7 communication comes out. I mean, it's worth reading. It is extremely ideologically progressive. There's a lot of stuff in here that is sort of a little bit mind blowing because this is supposed to be about energy, and it's very inclusive of everyone and everything, but not very inclusive of energy. And so it's all the way at 69. It's toward the back end. It's on page 27 of a 36-page document where they finally get to natural gas and LNG. And of course, this is in the midst of energy crises, and we're in war in Ukraine and things that Japan cares about seriously. Japan had Fukushima. They got rid of a lot of their nuclear. They're trying to bring that nuclear back. Last week, Germany just shut down 3 of their nuclear power plants.
Mhm.
Um, Lots of crazy stuff going on there. But so they say natural gas and LNG. Um, Quote, we recognize that Russia's war of aggression against Ukraine impacts energy markets and supply security globally and has intensified competition in securing resources. High energy prices and inflation have had a negative environmental, economic, and social impact on the economies and people's lives all over the world, especially in developing countries. through preventing them from securing affordable energy supply and the need for increasing the price of fertilizer and food. In this particular context, so they clarify this. In this particular context, and recognizing the primary need to accelerate the clean energy transition through energy savings and gas demand reduction, investment in the gas sector can be appropriate to help address potential market shortfalls provoked by the crisis, subject to clearly defined national circumstances and if implemented in a manner consistent with our climate objectives and without creating lock-in effects, for example, by ensuring that projects are integrated into national strategies for the development of low carbon and renewable hydrogen. So, I mean, kind of
Mm,
crazy because this is the one comment on natural gas, investment, which doesn't even say investment or basically says investment, but it's very qualified of, yes, you can maybe in a unique circumstance if it's in line, nothing with oil investment. So I think it's really damning and pretty terrifying from a global energy security
mm,
standpoint that we can barely even mention natural gas investment within a G7 communique document. And it's being pushed back heartily by the US and Europe to not have this
mm.
stuff in here.
Wow. Yeah, it's interesting. When was this communique
Last night.
divulged?
This came out last night.
Last night. Interesting. Wow. I know. I've thank you for the heads up. Yeah, I'll have to go check it out. But no, yeah, that's huh. Right. It's like where's the 100 years from now, yeah, I would expect the market share of total energy supplied in the world to be oil and gas to be lower than it is today. But yeah, maybe not completely left out of the conversation. So ooh, yeah, we'll see.
Yeah. Well, and it's
Interesting.
just something I throw out, not that you have to have a particular reaction or anything. It's just something I throw out of that I think I still think it's important. Your
Yeah.
day-to-day business is not, how oil prices swing you're not changing your day-to-day business, nor are you impacting your day-to-day business on something like this. However, I do think it's increasingly important for privates and publics and mid caps
Hmm.
to really appreciate that stuff like this
Sure.
matters. Because it comes down the
Hmm.
pipeline and we have to have more folks in the industry articulating what they do and how it's why there's a need to have your oil and natural gas production being produced and on the market.
Sure. So no, exactly. Yeah, that energy security absolutely vital. Would have thought we had a good example of that last year, but maybe we need another one.
Yes,
Hope,
apparently,
hopefully not acute.
yes.
Um,
Um, and this
so,
has been a year on. Well, Ryan, I've taken a lot of your time. Both of our German shepherds have woken up during the
yeah.
course of this hour. But thank you
Hmm.
so much for coming on the podcast, and we'll be having you back soon, hopefully, or in
All
the next
right. Yeah.
year.
Thanks for having me on.
All right.
Appreciate it.